Hi, it's John here with my top 10 tax tips for business owners and entrepreneurs. My last tip is all about timing. It brings together some of the other tips, but I want to stress how deadlines and timing can have a big impact on your tax bill. It's why planning is so important. So why is timing important? Well, if you own a limited company, you pay tax on the profits based on the year in which they're earned. And in some cases, you get the chance to decide when they are earned. As an example, if you're going to make a large purchase, it's better to make it the day before your year end than the day after. This is because you get the tax relief a whole year earlier. We actually had that the other year when a new client came to us because they were upset over the tax bill. They bought 3 vans for about £50,000. The year end was the 31st December and they bought them in the first week of January. If they bought them 1 week earlier in the last week of December, they'd have got exactly the same tax relief, around £10,000. They would have got it a whole year earlier, and that would have made a big difference on the cash flow. So that's the first thing about timing. The second is on dividends. If taking money out of the company's dividends, then you, as the owner, can decide when you take out that dividend. For example, you take the dividend out on the 5th of April, it's in a different tax year than if you take out the dividend on the 6th of April. Again, you can delay the tax bill by a year by taking the dividend 1 day later. But you also get a chance to look at the different thresholds and the effect that might have. As an example, if you're paying dividend tax at 7.5% of the basic rate taxpayer and have used up all of that 7.5% band by early March, you'd pay tax at 32.5% on the next dividend. So you might wait until April to do it. Conversely, if you haven't used all of your allowance, you might pull your dividends forward to get them into that year. Because once your allowance is gone for the year, it's gone. You also need to look at some of the other important thresholds that reset on the 6th of April every year. The first is your £2,000 tax-free dividend allowance. The next is when you become a higher rate taxpayer at £50,000. And £50,000 is also the point at which you start to lose any child benefit. When you hit £60,000, all of that child benefit is gone. So it might be worth capping yourself at £49,999 to keep that child benefit. The next big threshold is when you hit £100,000 because you start to lose your personal allowance as well. And the last one is the £150,000 mark where dividend tax goes up to 38.1% and you also start to lose your annual pension allowance. Therefore, think in advance about the time of when you spend money and when you take money from your business can have a massive impact on your tax bill. So, those are my 10 tip-top tax tips for entrepreneurs. As I said at the start, they're all quite simple. They're all legal. What does bring them together is they need a bit of planning. So, my big recommendation to you is to actually do that, to plan. Speak to your accountant. They can do a lot for you after the end of the year. They can do so much more if you speak to them before your accounting year ends, preferably with a couple of months of notice. Some leaves can be claimed later, but some need to be used up by the year-end deadlines. And if you're thinking of closing or selling your business, you can save a lot of tax by planning this a couple of years in advance. And that one definitely deserves its own detailed explanation in another video. Hope you found the top 10 tax tips useful, and I'll use some of them to cut your tax bill. If you would like more tips on tax, accounts and business, please subscribe to our YouTube channel and I'll see you soon.